What's up guys, my name is Nick and welcome to my channel. Recently I've come across a lot of what I think is misleading content online in regard to covered calls and short cash secured puts. There seems to be some debate over which is better, and it's usually in the context of trading the wheel option strategy. If you don't know what that is, but you'd like to learn more, I've included a link somewhere up there and you can check out how the trade works from another video I've made on this channel. Anyway, I thought it was time someone put this to bed once and for all, and the result is this video. Before we get into it though, do me a huge favour, smash the like button and subscribe to the channel. It costs you nothing, but it helps me out a ton. With that said guys, enjoy and I'll see you on the other side. Cheers. Covered calls are one of the most popular option trading strategies out there. In fact, this is typically the first strategy that many stock traders try when they initially take a look at options and options trading. Short puts are less well understood, and these issues typically relate to leverage. But to be clear, these two strategies have exactly the same risk and reward. Let's pull up the whiteboard and take a look at a quick example. ABC stock is trading at $100. The covered call is constructed from buying 100 shares of long stock at $100 a share and writing or selling a $100 call option for $3. The maximum profit from this position occurs above $100 and is equal to $3 per share. The maximum loss would occur if the stock went to zero and is $97. The short put is written at the $100 strike and the premium received is $3, which is also the maximum profit. The maximum loss would occur again if the stock went to zero by the option expiration date and is also $97. To be clear, any differences that there may appear to be in real-world pricing are solely due to the effects of interest rates and any dividends that might be paid between now and the option expiration dates. And while the specific impact of those variables is beyond the scope of today's video, be sure these two positions are essentially the same and share exactly the same risk-reward characteristics. The reason, in my opinion, so many people seem confused here is the way in which covered calls and short cash secured puts are typically structured. In trading the wheel, for example, the initial put right is typically below the stop price and therefore out of the money. The same is true for the covered call. The short call strike selected is usually out of the money as well and so above the stop price. The net result is that the positive delta on the short put is typically less than 50% since the put is below the stop price and out of the money. The net delta on the covered call position, on the other hand, is greater than 50, since the long stock has 100 positive deltas and the negative offsetting delta on the short call is less than 50%. This means that in a bull market, the covered call will likely outperform since the position has a higher net delta. To compare these two positions and declare one better than the other shows a total lack of understanding of the most basic concepts of both position equivalency and net delta. If I were to take a dozen traders and give them all the same single stock or ETF on which to trade the wheel strategy, and that was all I told them, I absolutely guarantee I would get 12 different profit and loss numbers, and the reason is simple. There are literally hundreds of different combinations of strike, time to expiration, and even approaches to strategy management. And it is this latter point, managing the position, where the real difference between the two positions becomes apparent. Let me explain. Look, if the wheel is traded in its purest form and no adjustments are made during any single cycle, then the two positions will return the same profit and losses by any given expiration date, provided the initial put and call strikes are the same. This is important, something we've touched on already in regard to the position net delta. So, clearly, for a reasonable comparison to be made, we'll assume the positions are equivalent, and so the short option strikes of both the put and the call will be the same. Let's look at a situation where we get a significant decline in the stop price early in an option cycle, and as a result we decide to adjust the position to protect that downside risk. Now I know many of you are thinking, but Nick, you shouldn't need to adjust any of these positions, just let the wheel do its thing. Yeah, that's great, except when you see not only 1, 2 or even 3 standard deviations tested to the downside, but moves like the magnitude we saw in March of 2020, for example, where no active self-directed investor or trader could reasonably be expected to sit on their hands and not intervene and take some sort of action to defend their position. It's just human nature. Trading inside a vacuum is hard. So, anyway, ABC stock has dropped sharply and is now lower in price. When we were trading at $100 a share, the initial delta on both the covered call and the short put was 50%. In fact, all the net Greeks on both positions are the same due to what is known as put-call parity. Now, however, the positive delta on both positions has increased. Let's say the call is now out of the money and is trading for just $1. Conversely, the put, of course, is now deep in the money. The covered call trader decides to buy back the short 100 call at a nice profit of $2 and sell a lower call, let's say the $97 strike. This brings in another $2 and reduces the long stock cost basis to $96 per share. This adjustment is called rolling the call down. If sufficient time does not remain in the current expiration cycle, it can also be rolled out further in time. The combination of these two adjustments will be referred to as rolling down and out. Now, don't forget, of course, the covered call trader is still running a loss on the long stock, but his average cost basis is now $96 a share, following the sale of the two call options, having collected $4 in net premiums. This adjustment both brings back the delta closer to the initial position delta of 50%, and the sale of the additional call further reduces the cost basis of the long stock holding. Our short put holder has the same predicament. The delta of the put is now higher, and they want to make an adjustment to bring this back in line as well. They could, of course, buy a lower strike put, but they are not keen to outlay any premium for this purchase, and so elect to also sell a 97 call option, and in doing so create a 97-100 strangle, which of course is inverted since the call is struck lower than the put. Importantly, notice that now the risk reward of the two positions is no longer the same. While the short put has collected $1 extra in premium, the short strangle now has theoretically unlimited upside risk due to the naked short call, which is not covered by stock. If the counter does rally back above $97 from these levels, the covered call holder would effectively take just a $1 profit from the trade, since his short 97 call option will be exercised and his stock called away. The short strangle holder is hoping for the stock to trade in between the short strikes of 97 and 100 by the expiration date. This is where his maximum profit of $2 would be achieved. This is because while he receives $5 in net premiums, the strangle is inverted by $3, and so this is the least it can ever be worth. So, between the short strikes, he would actually make more than the covered call holder by $1. But that's not quite the end of the story though, of course, since any continued rally above and beyond the $100 strike leads to additional losses. There's no need to be alarmist here, okay? It is possible to effectively manage the risk of short strangle positions, but this is certainly not a novice strategy and requires more skill and experience than running the far simpler covered call position. In summary then, covered calls and cash secured puts are equivalent positions when the short option is initiated at the same strike and in the same expiration. In a pure model where no adjustments are made and positions are run to expiration, a wheel trade using either of these setups will generate almost identical returns. The difference in the two trades do not become apparent until steps are taken to mitigate delta risk by adjusting the position when the price of a stock falls. Depending on the adjustments made, the relative risk reward of the positions can change, and the management of the short put can become potentially problematic and more complex. The reason why this is not an issue when the stock rallies, on the other hand, is that the short call is covered by the stock. Using a similar adjustment strategy, we could of course take profit on the short put and roll this higher to generate an additional credit to take advantage of further gains in the stock and reset our deltas closer to our position opening levels of 50%. Unlike the losses incurred on the short put when the stock falls, actual losses are not incurred on the covered call as such. The position still makes a profit, but there's an opportunity cost. We are missing out if and when the stock continues to rally much higher. We covered some fairly complex concepts today, and if you made it this far, I'm not only very impressed, but also very grateful for your support. If you enjoyed the video, do me a huge favor and subscribe to the channel down here, and you can watch additional option-related content by clicking somewhere over there. If you have any questions or feedback, please feel free to drop them in the comments section below. I do respond to them all personally. Again, many thanks, and I'll see you on the next one. Until then, take it easy. Cheers.